It is 6:11 on a Thursday morning in a quiet neighborhood outside of Minneapolis, and Harold is sitting at his kitchen counter with a single printed spreadsheet laid flat under the overhead light. The fluorescent glow catches the edge of his coffee mug and throws a pale rectangle across the page, illuminating a column of numbers he has read 4 times already. His retirement portfolio says $738,400, and the number next to it, the one his old financial advisor circled in blue ink, says he can safely withdraw $29,536 per year for the rest of his life. Harold traces that figure with his index finger, and something about it feels too thin, like a winter coat that looked warm enough on the hanger but lets the wind right through. He hasn't touched the coffee yet. His hand hovers over a calculator on the counter, but he doesn't pick it up because the arithmetic isn't really the problem. The problem is that groceries cost more than they did 3 years ago. His property taxes climbed again, and the $29,536 number assumes the world stays still while he draws it down. He can feel the gap between what that spreadsheet promises and what his actual life costs, and the gap has a weight to it that sits right below his ribs. Harold stares at the blue circle and wonders if the rule he built his entire plan around was already broken before he retired. His situation is far from unusual. The majority of people entering retirement in the last few years have leaned on the same withdrawal formula, and most of them are discovering that it belongs to an economic era that no longer exists. The problem has a name, and it is called sequence of returns risk, layered on top of persistent inflation. But almost nobody explains what that actually means for your monthly bank balance. This matters more than most retirement topics. The withdrawal rate you choose in your first 5 years of retirement can determine whether your money outlasts you or runs dry a decade too early. And what you are about to see is a framework that replaces the old rule with something that actually responds to the life you are living right now. By the end of this, you'll understand exactly why the classic 4% rule was built for a world that no longer matches yours. You'll see the 3 specific forces that have made it dangerous to follow blindly in the current environment. You'll learn a flexible withdrawal method that adjusts to inflation, market drops, and your own tax bracket in real time. And you'll have a clear sequence of steps you can begin executing before this calendar year ends. You don't need a finance degree or a spreadsheet certification to follow this. You need 20 minutes of honest attention and the willingness to look at your own numbers without flinching. Retirement is not just a longer weekend. It is a fundamentally different financial machine than the one you operated during your working years. When you were earning a paycheck, money flowed in one direction, and your main job was to save a portion of it before taxes and spending consumed the rest. Once you stop working, the flow reverses, and every dollar you pull out has to come from somewhere specific. A traditional IRA, a Roth account, a brokerage account, or Social Security. If you've recently retired or you're within a few years of doing so, think about your own situation for a moment. You probably have money scattered across 2 or 3 of these buckets, and the order in which you tap them changes everything. Each of those sources carries a different tax treatment, and the sequence you choose determines not just how much you keep, but how long the whole structure holds together. Think of your retirement income like a recipe with 4 or 5 ingredients that each need to be added at the right temperature and in the right order. If you toss everything in at once, the flavors clash and the dish falls apart. But if you layer each ingredient at the moment it does the most good, the result is something that holds together beautifully. Your withdrawal strategy works exactly the same way. Timing and proportion matter far more than the raw total. The 4% rule treated your portfolio like a single pot of soup and told you to ladle out the same amount each year, regardless of what was in the pot or how hot the stove was running. Your traditional 401k and traditional IRA are funded with pre-tax dollars, which means every cent you contributed reduced your taxable income in the year you earned it. That felt like a gift at the time, and in many cases it was, but the IRS did not forget about that money. When you withdraw from these accounts in retirement, every dollar comes out as ordinary income, taxed at whatever federal bracket you land in that year. If you pull out $60,000 from a traditional IRA, the IRS treats it identically to earning a $60,000 salary, and it stacks on top of any Social Security income or pension you already receive. The effective rate you pay depends on how high that stack reaches. Your Roth IRA and Roth 401k operate on the opposite principle. You funded them with money that was already taxed in the year you earned it. Because you paid the tax bill up front, qualified withdrawals in retirement come out completely free of federal income tax, including all of the growth those contributions generated over the years. This distinction matters enormously when you are deciding which account to tap first, because a dollar withdrawn from a Roth does not raise your adjusted gross income. That single fact cascades into your Medicare premiums, your Social Security taxation, and your eligibility for certain deductions. Consequences that a traditional withdrawal triggers, but a Roth withdrawal avoids entirely. Your taxable brokerage account sits in a third category, where the gains you have accumulated are taxed as capital gains rather than ordinary income. Long-term capital gains rates are generally lower than ordinary income rates for most retirees, which makes this bucket a useful middle layer. The real art of retirement income is not picking one account. It is blending all three in the right proportions each year, the way a good recipe balances salt, acid, and heat to get the flavor exactly where it needs to be. Most retirees follow a simple and understandable instinct. Withdraw from the account that has the most money, or withdraw evenly from everything, or just follow the 4% rule across the total balance. That instinct feels responsible because it seems cautious and balanced, and it echoes the advice that was repeated for decades in every retirement magazine and television segment. The reason it feels right is because it treats all dollars as equal, which is the habit your brain formed during 40 years of earning a paycheck where a dollar was just a dollar. But in retirement, a dollar from your traditional IRA and a dollar from your Roth are not the same dollar at all. Here is the first invisible consequence of following the old rule without adjusting for your tax map. If your combined income pushes you from the 12% federal tax bracket into the 22% bracket, every dollar above that threshold costs you nearly twice as much in tax as the dollar just below it. For a married couple filing jointly, that jump happens around $96,950 of taxable income in the current brackets, and it is surprisingly easy to cross it without realizing you have done so. A large traditional IRA withdrawal stacked on top of Social Security can push you across that line in a single year. The math is not dramatic. It is mechanical, which is exactly what makes it dangerous, because you will not feel the bracket change until you see the tax bill the following April. The second invisible consequence is Medicare's income-related monthly adjustment amount, known as IRMA. Medicare looks at your modified adjusted gross income from 2 years prior, and if that number exceeds certain thresholds, your Part B and Part D premiums jump to a higher tier. For a married couple, crossing the first IRMA threshold means paying over $420 per month for Part B instead of the standard $185 base premium, and that surcharge applies to each spouse separately. This penalty is not a one-time event. It recalculates every year based on your income, which means a single year of heavy withdrawals from a traditional account can cost you thousands in extra Medicare premiums 2 years later. If you've been pulling from your traditional IRA without tracking your modified adjusted gross income, run the numbers on your own withdrawals from last year, and you'll see whether this has already started happening to you. Most retirees discover IRMA only after the surcharge letter arrives in the mail. The third invisible consequence is the taxation of your Social Security benefits. If your combined income, which the IRS defines as your adjusted gross income plus non-taxable interest, plus half of your Social Security benefit, exceeds $44,000 for a married couple filing jointly, up to 85% of your Social Security becomes taxable as ordinary income. That means the benefit you earned over decades of payroll taxes gets partially absorbed back into your tax bill, effectively reducing the net amount you actually keep. This creates a cascading effect. A large traditional IRA withdrawal raises your adjusted gross income, which raises the taxable portion of your Social Security, which raises your adjusted gross income even further, which can trigger the IRMA surcharge on top of everything else. The cascade is quiet and cumulative, and it compounds every year you follow the same withdrawal pattern. Harold, sitting at that counter in Minneapolis, had been withdrawing exactly 4% of his portfolio balance from his traditional IRA every January for 3 straight years. He never crossed into a dramatically high tax bracket in any single year, but the steady withdrawals had quietly pushed his combined income past the IRMA threshold and triggered 85% Social Security taxation simultaneously. By the time he added up the extra Medicare premiums and the additional tax on his Social Security, he was losing over $6,200 per year to consequences he never saw coming. The dominoes keep falling, And every year you wait to rearrange them is another year the cascade charges you for standing still. The real cost of an unexamined withdrawal strategy is not what you pay in any single April. It is what you pay cumulatively over 15 to 20 years of retirement. If the cascade of bracket creep, IRMA surcharges, and Social Security taxation cost you an extra $6,200 per year, that is $93,000 over 15 years. And the math gets worse when you factor in the growth those dollars could have generated if they had stayed invested. A retiree who keeps an extra $6,200 per year in a diversified portfolio, averaging even a modest return, ends up with a difference well above $120,000 over that same period. The 4% rule never accounted for this compounding drain because it was designed before IRMA existed and before Social Security taxation thresholds were set at levels that most middle-class retirees would eventually cross. There is a window that opens for most retirees between the year they stop working and the year they turn 73, when required minimum distributions begin forcing money out of traditional accounts. During this window, your taxable income often drops significantly because you no longer have a salary filling up your brackets, and Social Security may not have started yet, or may be at a reduced amount if you claimed early. This is the period when your lower tax brackets are sitting empty, like an oven preheated to the perfect temperature with nothing inside it. Most retirees leave those brackets unfilled, either because they are living off savings in a taxable account, or because they are afraid to touch their traditional IRA until they have to. That instinct, waiting as long as possible, feels prudent, but actually wastes the cheapest tax base you will ever have access to. The strategy that changes everything is deliberately converting portions of your traditional IRA into a Roth IRA during those low-income years, paying tax at the 12% or even the 22% bracket now, instead of being forced to pay at a higher rate when RMDs begin. You are not avoiding tax, you are choosing when to pay it, and the difference between paying voluntarily at 12% today and being forced to pay at 24% in 8 years is enormous. Each dollar you convert becomes permanently tax-free inside the Roth, which means it will never again contribute to your adjusted gross income, never trigger IRMA, and never cause your Social Security to become more taxable. The math behind this is not theoretical. It is arithmetic that any calculator can confirm. And it works because the tax code rewards those who plan the timing of their income deliberately. A Roth conversion is simply the act of moving money from the taxed later account to the taxed never again account at a rate you choose. When you convert a dollar from a traditional IRA to a Roth, you pay ordinary income tax on that dollar in the year of conversion. But from that point forward, it grows tax-free and comes out tax-free for the rest of your life. The key is to convert only enough each year to fill your current bracket without spilling into the next one, layering the conversions like seasoning added gradually rather than dumped in all at once. Over 5 to 8 years of strategic conversions, you can substantially reduce the size of your traditional IRA, which directly reduces your future RMDs. Smaller RMDs mean lower adjusted gross income in your 70s and 80s, which means lower taxes, lower Medicare premiums, and more of your Social Security staying in your pocket. The recipe comes down to this: pay a manageable tax bill now, in the years when your income is low, to permanently eliminate a much larger tax bill later, in the years when the IRS forces you to withdraw. Ask yourself which tax bracket you're actually sitting in right now. If it's the 12% bracket and you're not filling it to the top, you're leaving the cheapest tax space in the code completely empty. The retirees who come out ahead are not the ones who avoided taxes the longest, but the ones who chose to pay them at the right temperature. Timing is the only ingredient the 4% rule never included. And it turns out timing is the one that determines whether the whole recipe holds together or falls apart. Patricia is 64 years old, recently retired from a career in hospital administration outside of Richmond, Virginia. She has $610,000 in a traditional 401k that she rolled into a traditional IRA, $47,500 in a Roth IRA she opened 12 years ago, and $83,200 in a taxable brokerage account holding index funds. Her Social Security benefit, which she plans to claim at 66, will be $2,310 per month, and her annual living expenses, including property tax and Medicare premiums, run about $54,800. Patricia is single and files her taxes as a single filer. Patricia decides to follow the conventional path. She waits to claim Social Security, and in the meantime, she withdraws $54,800 each year from her traditional IRA to cover expenses. That single withdrawal pushes her taxable income into the 22% bracket after the standard deduction. And because she is pulling the full amount from a pre-tax account, every dollar above the 12% threshold is taxed at nearly double the rate it needed to be. Once her Social Security starts, the combined income triggers 85% taxation on her benefits and nudges her modified adjusted gross income past the first IRMA threshold, adding roughly $3,100 per year in extra Medicare premiums she was not expecting. Over the first 10 years of her retirement, Patricia pays approximately $31,840 more in federal taxes and Medicare surcharges than she needed to. If your situation looks anything like hers, a large traditional IRA, modest Roth savings, and a plan to just draw from the biggest account, you're not alone. But you need to know that it's costing you more than you think. Daniel is 64, recently retired from managing a regional distribution warehouse near Columbus, Ohio. He has $585,000 in a traditional IRA, $72,600 in a Roth IRA, and $61,400 in a taxable brokerage account, with the same Social Security benefit of $2,310 per month starting at 66 and annual expenses of $53,600. His total portfolio is actually smaller than Patricia's, but his money is distributed slightly differently across the three buckets, and more importantly, his withdrawal sequence is completely different. Daniel starts by covering his expenses from a blend of sources. He takes $22,000 from his taxable brokerage account, where the long-term capital gains rate is 0% on the first layer of gains for his income level, and he pulls $16,150 from his traditional IRA to bring his taxable income up to, but not past the top of the 12% bracket after the standard deduction. The remaining $15,450 in expenses comes from his Roth IRA, which adds zero to his adjusted gross income and triggers no tax consequence at all. His total federal income tax bill in that first year is approximately $1,935, compared to Patricia's bill of roughly $7,400 on a similar amount of spending. Once his Social Security begins, he reduces the traditional IRA draw and lets the benefit replace part of the brokerage and Roth draws, keeping his combined income well below the IRMA threshold and holding his Social Security taxation at roughly 50% instead of 85%. Over the same 10 years, Daniel pays approximately $18,700 less in total federal tax and Medicare surcharges than Patricia. But Daniel does something else during those first 2 years before Social Security starts, when his income is at its lowest. He converts an additional $38,000 per year from his traditional IRA to his Roth IRA, filling the 12% bracket to the brim and paying approximately $4,560 per year in conversion tax. That $76,000 total conversion reduces his future required minimum distributions by roughly $3,800 per year once he turns 73, and every dollar of that converted balance will grow and withdraw tax-free for the rest of his life. The math over 20 years of avoided RMD taxes, avoided IRMA triggers, and reduced Social Security taxation produces an additional estimated savings of $52,700 beyond the $18,700 he already saved through sequencing alone. If your income is unusually low this year, maybe you just retired, maybe you had a gap between your last paycheck and your first Social Security deposit, this is your window to do the same thing, and it won't stay open once your required minimum distributions begin. The cumulative difference between Patricia's approach and Daniel's approach over a 20-year retirement is approximately $71,400. And both of them started with nearly the same amount of money, the same Social Security benefit, and the same annual expenses. That difference did not come from earning a higher return or taking more risk. It came entirely from the order and timing of withdrawals and a deliberate Roth conversion during the lowest income years. The recipe was the same set of ingredients arranged in a completely different sequence. The first thing to do is gather every account statement you have: traditional IRA, Roth IRA, 401k, brokerage, savings, and write down the current balance and the tax treatment of each one. You need to see the full picture before you can build a withdrawal sequence, because most mistakes come from treating each account in isolation rather than as ingredients in a single recipe. If you have accounts with a former employer that you have not rolled over, this is the time to consolidate them so you can manage the proportions clearly. The second step is to map out your expected income for the coming year, starting with Social Security if you are currently receiving it, any pension, any part-time earnings, and any required minimum distributions you are obligated to take. Add those up and compare the total to your annual living expenses. The difference between what is already coming in and what you actually need to spend is the gap you need to fill from your portfolio. Knowing the exact size of that gap is critical because it tells you how much room you have left in your current tax bracket after the income that is already locked in. Most retirees have never calculated this number, and once you do, you will immediately see whether you are overflowing your bracket or leaving cheap tax space unfilled. The third step is to fill that gap in the right order. Draw first from the account that produces the least taxable income at your current bracket level. Then layer in traditional IRA withdrawals only up to the point where you reach the top of your target bracket, and cover any remaining expenses from your Roth. If there is still room in your bracket after covering expenses, that leftover space is where a Roth conversion fits. You are paying tax at today's low rate to permanently remove dollars from your future RMD obligations. The temperature of your bracket determines how much seasoning you can add without burning the dish, and the goal is to use every degree of that heat without going over. The fourth step is to revisit these numbers before December 31st of every year, because your bracket space resets on January 1st, and any unused room is gone forever. This is not a set-it-and-forget-it recipe. It is one that needs to be checked and adjusted each year as your income, expenses, and account balances shift. Your next move is the one that matters most, and before this year ends, you owe it to yourself to sit down with a CPA or fee-only financial planner who can verify your numbers and confirm that your withdrawal sequence is aligned with the current tax brackets. A single planning session before year-end can save you more than a decade of regret. Harold eventually closed that spreadsheet in Minneapolis and opened a different one that separated his portfolio into 3 columns instead of 1, and mapped the tax cost of each withdrawal path. He did not abandon the idea of a sustainable withdrawal rate, but he stopped treating his portfolio as a single number with a single rule attached to it. What he built instead was a sequence that respected the different temperatures of each account, drawing from each one at the moment when its tax cost was lowest and converting traditional dollars into Roth dollars during the years when his bracket had the most room. The recipe for retirement income was never about finding a single magic percentage and repeating it for 30 years. It was always about understanding the ingredients you have, the order in which they should be added, and the temperature of the bracket you are cooking in right now. The 4% rule gave people a starting point, and that was valuable, but a starting point is not a strategy. The retirees who keep the most of what they have saved are the ones who learn to adjust the seasoning every single year. If you have been following a fixed withdrawal rule without looking at the tax consequences, drop a comment below and tell me what your biggest question is about switching to a sequenced approach. If this changed the way you think about your own retirement income, a like helps other people in the same situation find this before the year runs out. Your spreadsheet is waiting, and now you know what to do with it.